You need one of those
Alright.
clappers. All right, thank you, everybody.
Thanks, Fred.
The hardest part of doing a talk like this to complete strangers is you don't know who I am, where I typically do this and the room is filled with people that paid to see me talk. So why am I here in Phoenixville? I was telling the people that came here live, 22 years ago, I was a nobody. And for some of you, I'm still a nobody, which is fine. And Mark said, hey, and I came to the library, hey, I'd like to do a talk about investing 101 or retirement 101. And he's like, okay.
Yeah.
So 22 years later, that I'm, this thing, a version of this, I get paid to do. There's no bill, never going to be a bill to the library. Hey, welcome. How are you?
Good, how are you?
Have a seat wherever you want. And I told my office, whenever Mark asks for anything, just say yes and put it in the schedule. So, I don't know, was it 2 months ago this got put in? Or
Yeah,
longer?
yeah, 2 months ago, yep.
We're now talking months for me. So, a little bit of background. I came from Delaware County. I still say water. And in 1999, I moved to Phoenixville. I worked for Unisys at the time, and then I left and I started with a brokerage firm that's a national firm that you would know, but I left them, so I don't tell you who they are. I'll tell you when it's not recording. I opened up the Kimberton, Phoenixville office of this firm, and my first day was 9/11.
Oh.
So I have an MBA, and if I do this right, you're never going to hear my MBA. I'm not trying to talk above anybody, make me feel smart, and you feel this is about explaining things to people in a way they understand it. So I left this firm, and the neat thing about the firm was everything was a lot of computerized, and I'd come in on a Monday, and true story, there's a list of clients, and Merck, I think, was the stock of the day. And I was naive enough to call the investment company. I have an MBA, but I never sold investments before. Now I'm an advisor for this group, and I'm running the Phoenixville, Kimberton branch myself. And I was naive enough to call and say, hey, there's Merck, and there's these list of customers. How do we know these customers need Merck? The guy's like, you're kidding, right? I'm like, no, I'm honest. How do you know? Because my dad was on the list. My dad was at the top of the list. He's like, they're the people with cash, and Merck's the stock of the week. Do your job. Like, oh, whoa, okay, before you hang up on me, how do you know they need Merck? Maybe they already have all these. He's like, that's not my problem. Click. So I realized very shortly after, and this is 9/11, and the interesting thing was starting during 9/11, I had to drive to get my license to finish the training that I was already set up for. And when you ask the person, you come back to the office, and after 9/11, for weeks there was still smoke and all, it was horrible. You call whoever I talked to, the answer to what do I do now was always the person's product they sold. So I call the American Funds company, great fund family. Hey, now's the best time for capital income builder. I talk to the bond desk, well, you should be adding more in bonds. Like, you both can't be right. Like, you both can't, like, literally you both can't be right. And then the annuity guy is like, oh, that's best time for I'm like, all right. And it took me maybe 3 months to realize the industry was a sales industry. Securities or stocks and bond mutual, that's just the thing they're selling. It's not necessarily advice. It's under a wrapper of advice. And that was my dad's money. And I'm like, this isn't this. So I spent 2 years trying to fit in the system. I wanted to be fee-based, which is the opposite of commission. And the entire industry, looking around, is based on find someone you like, they charge you 1%, they put your money in harm's way with stocks and bonds, and then they give you the advice. And the advice might be, don't do anything yet, or don't buy this, you go over there. So I lasted 2 years at a brokerage firm, and then I started my own company. And Valley Forge Commons, number 3, I was the place that everyone came in and said, are you my podiatrist, or where is my podiatrist? And I have an MBA, but everyone around me was doctors. We have dentists, we have, although my friend's a chiropractor, and I'm like, you're not really a doctor, but anyway, he's my friend. He's a real doctor. But now I'm in my own office, and no one's telling me anything. So I left an office that said, here's cash, and your dad should buy Merck because he has cash, to crickets, because I have my own business now. Mark, I don't know if they need you, but they're looking in. Just heads up. So I cheated, like all good, smart, hardworking MBAs, I cheated. If you Google, and it's still today, if you start looking like best portfolio, best investments, best investment portfolio, you eventually always get to Harvard and Yale, the endowment. Now they don't pay taxes and they don't die. So if you figure out how to do one of those, I'll come work for you. We'll take over the world. But until then, what they can do, and what they have to do, is they have to show their annual report every year. So now I'm on my own, and I'm like, all right, where are the people with real money actually going? Like, what are the smart people doing? And Harvard and Yale Foundation always shows up. Hi, come on in. Harvard and Yale Foundation always shows up. And it still does today. You can see the annual report. Here's the thing that was the biggest aha moment, and it created my company. About 70 to 80% of where Harvard and Yale manage, where they have the endowment, is not in the stock market. And I'm like, well, that's really weird, because I just left from a brokerage firm where every answer was a stock market or an investment or a bond, you know, it was something that was in the market. And what it dawned on me was 80% of the money is not in the market. Only about 20 to 30%, depending on which one you're looking at, is in the stock market. And when you do the research, the things I want you to leave with are things that are not only true, but you've never heard before, because no one wants to tell you what the truth is. And Mark knows this. I'm here to serve, not sell. I could care less. You know, I don't have an interest in this other than I've been up the mountain. I know how wealth is made. I can tell you the good, the bad, the ugly, and I also can tell you the things that are true, but you have to do some research. So there's about 3,400 tickers in all of the market. So we think it's this gigantic ocean. It is a 4-inch lake. And the Harvard and you know, the BlackRocks and the Vanguards and the Fidelity, they're all flat bottom boats. They look like gigantic cruise ships, and they are very big, and they have a lot of people in them. But they're all fishing in the same model. And I'm going to share with you, and unfortunately it's going to be in the library for in perpetuity, so there will be no names in this story, but we had a client, it was over Zoom, thank God, because I'm about to tell you something that, if it was in person, I would be scared for my personal security. But true story, guy had $17 million, all in mutual funds with 4 different advisors. So a few aha moments I will leave you with. Number one, there are not that many stock tickers that people actually own. So of the 34 tickers that are available, people all are kind of in the same 800 to 1,200. There's only so many Facebooks, ExxonMobil, Tesla, IBM. You know, there's not a ton of businesses. So this guy thought he was diversified, $17 million, 4 different advisors, and they're all doing their own thing. Yeah, shoot. And yeah, I'd love this to be
Oh, I'm sorry.
No, I would love this. I want this. Thank you.
I just want to make sure you're talking about public.
Public companies. Yeah, there's 600 private, and that's why private equity is one of my answers.
There's only 600 private?
There's 600,000 private companies.
Oh,
yeah.
there's...
Because I'm private, and you know, if you had a side job, you'd be private. So
okay.
You're right. So I'm talking tickers that you can put into E-Trade and buy. There's about 3,400 total. The NASDAQ 2000, that index, doesn't even have 2,000 things in it anymore, because people merge, people go bankrupt, and no one really is getting in. There's not a lot of new NASDAQ stocks anymore. I don't think it's been years since a new stock was created, because they're all merging and you know. So you have, this guy had $17 million, and I haven't got off the first slide, so I'll catch up, I promise. But you got to know this to kind of set everything else up. We have software that looks at people's holdings, and we can see the overlap. And ironically, because he had 4 people who didn't talk to each other, 4 separate advisors, and he thought he was devout, and every advisor put it into mutual funds. Now, the second thing I want you to know is mutual funds were designed for poor people to invest. There's no other way around it. I hate to say that, but if you put $100, you really can't buy a lot of stock, but you can put that in a mutual fund. There's a place for that. 17 million bucks shouldn't be in a mutual fund. Like, it's just, but the people that all they do is make mutual funds and ETFs are the last person in the room to tell you no, because that's the way they make their money. They're not going to tell you no. And that's fine. And again, I'm not saying it's wrong. So this guy had 4 different advisors. Our software looked at all the 4 different buckets he had. He matched identically to the S&P 500. So the percentage of his assets that were telecommunications and healthcare and finance and all the other categories, ironically just overlapped 1-to-1. If the S&P was 12%, his assets were 12%. And they didn't do it on purpose. It was definitely a fluke. So the part that is unprofessional for me to enjoy, and I enjoyed again telling you the story, and I'm going to continue enjoying it because I just enjoy it. I told this guy, listen, you don't need me, and you really don't need your other 4 advisors. All you need to do is put all your money in SPY, which is a very low, you know, anything that any S&P index, but the SPY is a decent index. And he sat there like this, like, isn't it stupid to have all my money, all $17 million in one thing? And this is the part that was unprofessional for me. I said, yes, and you already did it. and I just let it sit. Okay. So I'm thinking to myself, this guy's worth 17 million bucks. I'm going to find out. And his answer was, what do we do about it? So he didn't get upset. I had the receipts. I showed him right there, hey, you have overlap. So that concept of what things really work, how things really work, the 80% that Harvard and Yale have invested in non-stock market things are categorized by the government and the regulators as an accredited investment. An accredited investment is restricted, meaning I can only tell you about it in an educational format. I have no tickers to give you. I'm not soliciting. There's no company names in what I'm talking about today. This is not about selling anything, because I have to know that if I'm going to recommend, hey, you should do XYZ alternative investment, you have to be accredited for most of the things we do. Most of my office, for the first 15 years of me doing it, they looked like me and my dad and my parents, and they were normal people that had some money, a couple $100,000, not a couple $100 million, and so they didn't qualify for alternative investments, but they got me where I'm at, and so we now have enough clout with some of these alternative investments companies that we have access to things that are for called a later accreditation, so 70,000 of net worth or income, not $1 million. So still not for everybody. But if you ever thought the rich got richer because they know things that the rest of us didn't, I didn't come from money. I was joking, not joking. I grew up in Delaware County. I still say water. I bleed the Eagles green, so I am not a fancy, sophisticated New York guy. Although that suit looks nice on me, but wasn't a rent suit. So I'm going to walk you through all the things I think you need to know. We are going to cover some of your questions. Here's the fine print. Don't do anything I'm talking about. These are not investments that I'm going to even tell you the name of, but these are not meant, this is meant to be an education so you know what's out there. I am not soliciting because I don't even have business cards on me. This is how the top 1% invest. So this isn't a class to say, here's what you should do. This is, I don't know what you're doing, and I don't need to know what you're doing. Here's what they're doing. And in 22 years, I can tell you this is why it works for them. So this really is a different workshop. This isn't a workshop to say, oh wow, I'm going to go give him my money. No, this is a deep dive, ask me anything about how the wealthy people know things, do things, have things that the rest of us don't, because I used to be the rest of us. It's a normal frustration for me because I couldn't do some things for my dad because he wasn't accredited until later, thanks to me, but he wasn't accredited at the beginning. I could do things for complete strangers who just happen to have different numbers. So if you ever felt the rich get richer because they know things the rest of us don't, is not only 100% true, and I can back it up, it's a government program called accreditation. The government regulates people like me on who and how we can talk to everybody. Anyone can buy a mutual fund as long as you're 18 years old. My stuff, not so much, which is why I want to educate people on it, because you're never going to see an advertisement on this stuff. It is illegal to advertise, and none of it is stuff I make. So one of the partners, and one of the things I'm going to go over, you're going to not only know the company, there is a building in Phoenixville, which is one of the investments we're funding right now. It's already sold out. I'm not funding it to you. I just want to show you that the wealth created in the world is right under your nose, but you just walk by an $80 million building, don't even think who owns it. Well, it's people that have money that bought the building, and I'll walk you through that. So I got some bombs, good stuff, not bombs in bad ways, but fun stuff. All right, so the neat things for number 4, we have access. We can send information. Not everything I'm going to share with you will be a carrot that's so far out you're never going to see it. We have alternative investment things that look and act like an alternative investment because they're not in the market. The market can't go down and take this down. There is there's no free ride, so there's some gotchas, whether it's a hold for 5 years. There's going to be something you have to give up if you're going to get an investment that's not exposed to the stock market, and we're going to talk about risks. But we do have some versions of investments that you're going to see today that are not for the $1 million. They're for the $70,000 of net worth. Now, the minimums might still be 10 grand. We're not talking you need 70,000 put into it. It's just, can you see the investment? Depends on the individual investor's net worth. I'm going to walk through all of it because I think you need to see everything that's out there, but also show you the stuff that isn't just for the super wealthy that anyone can consider looking at. Does that make sense? Sound like a plan? So I like to just bottom line stuff. This is a flagship model we've created and updated over the last 22 years. Not an answer to everyone's question, but it gives us a place to start from. We basically want, if someone said here's $1 million or here's $10 million, we know nothing else about them, because then this is tailored after we see it. But basically 50% is traditional. So we're starting at the back, at the bottom. Traditional, this is your stocks and bonds. This is you buy it today, you can get out tomorrow. In our world, we do fee-based. We don't want to be commission-based, because if we make money, whether you make money, that's not fair to you. So most people, this is all they ever will have. They will have mutual funds and ETFs and, the Vanguards of the world, the BlackRocks. They tend to be traditional. There's a place for that. We're not against that. We kind of limit it to about 50% traditional. There's probably 15 people that Mark's going to have talking about how to invest traditionally, so I'm not going to bother that. This is your age minus 60, and there's books written on that. That's not where we're at. The rest of the stuff we want to talk about, just so you know what else is out there. Absolute return, which is 10% of the portfolio. I can tell you what I recommend, and you can do it without. You don't need me. Is cash. If cash is getting over 4.5%, and there's a lot of places around here, and if not, there's a lot of online banks, and if not, let me know. Tell me. I'll tell you the banks that we know are decent. But basically, if you look at some of Harvard and Yale's endowment, they had a very complicated multi-money manager absolute return sleeve that got a whopping 3% last year after fees. Woohoo. If you can get 4% in cash with no fees, that's even a better woohoo. Like that is, so to me, absolute return is something that can't go down no matter what. And with cash paying better than it was before, there's no reason not to do that. Now the interesting thing about cash, Warren Buffett and private equity. So we're going to talk about private equity a few times, because you can't talk about alternative investments, and you really can't talk about Harvard and Yale without talking about private equity. The stock market thesis, and this again will be another bomb that most people won't ever say out loud, and I'm self-employed, so I don't have to worry about getting fired, as long as what I'm saying is true. Most people want to make sure that where they're putting their money is where it belongs, and they have no frame of reference, because the person telling them put it here is the person making money on them putting it here. And that's just the way it is, and which really stinks. So absolute return, we use cash because it can't go to zero, and with interest rates being as good as they are, you don't have to lock it up in a CD. Getting to private equity, if you remember Richard Gere and Pretty Woman, that's private equity. You buy a company and break it apart. Or you see two companies and you put them together and they work better together. Private equity and Warren Buffett have more in cash today than in the history of the tracking of private equity or Warren Buffett. So politics aside, there is a lot of cracks in the dam of our economy and our finances. No matter who gets elected, half the country's going to hate the other half. And that's all fixable over time, but some of the cracks are not as fixable. We're paying more in interest as a country than our defense budget. That's not sustainable. For people in Social Security, it's running out. My kids are 12, they're probably not going to have it. I'm 51, I'm paying into something I'm probably not going to see. So all of the guys and girls in firms with a lot of money, they're holding cash because they think there's going to be a buying opportunity, which means probably something not good's happening. And last presidential election, we had a pandemic, so I don't know what's on this year's bingo card of presidential elections. But absolute return, we use cash, and it doesn't have to be with us. Like as long as you get over 4%, I wouldn't say this is right for everybody. I'm just telling you what we're doing in most cases. Private real estate, there's no one worth millions of dollars in the 22-year history that doesn't have something in real estate. They either made it somewhere else and bought real estate with the money, or they bought the real estate, fixed and flipped and managed it and made their wealth in real estate. Either way, their balance sheet always has real estate. The downside is, what if you're a working professional? I've had rental properties. They're not fun. You get the calls all the time, and if you're in a conference call and you have to tell I'm sorry, looks like my toilet's leaking at the rental, like you're not going to keep your job. So there's ways to do private real estate that you're outsourcing some of it. I'm going to walk you through what we do. And then accredited private investments, these are things that are short-lived, and I'm going to walk you through what they are. We're going to go into all of these. This is just a high-level way, but these are short-lived, maybe 5 to 7 year turnaround projects that aren't, again, from this side up, we're not in the market, not in the stock market. So whatever, Biden says or Trump says isn't going to affect the market. Even if it affects the market, it isn't going to affect this stuff because it's not in the market. So the whole point of alternative investment, it really is a place where you can put money, and there's risk, but the risk isn't stock market risk. There's other risk, could be liquidity risk, because you can't get your money out for a while. It's operator risk, because the guy takes the money and doesn't do what he said he's going to do. There's a bunch of risks, but stock market won't be a risk if you're doing a non-stock market alternative. But don't worry, there's other risks. So I'm breaking this down between income and growth, because you can have had a bowl of water, and I asked you to steam, boil it so it steams, and ask you to freeze it so it's a block of ice. You're going to look at each other, look at me, and look at the bowl of water and say, Fred, pick one. Because water can't be two states of property. But with a straight face, most investors say, here's my retirement. I need it to grow. I need it not to go down. I need it to have income. I need it to be liquid. That's 4 different states of water. Like you can have something that does all 4, it'll do all 4 very, very horribly. But if you have something that's built for growth, it's probably not going to be liquid. It's probably not going to give you a lot of income. Like you have a trade-off, and as long as someone understands the trade-off and it works as advertised, you're going to be okay. But you can't have one bowl of water be your highest income, your best growth. So to answer your question having to do with smart decisions, it's that triage. It's here's my risk money. Well, that's where the money you do to take the risk. It's not the money you need for college, because your kids are going to be 18 no matter what the stock market does, so you have to do something different for that. And you match the asset to the purpose of the asset. This is my retirement in 20 years. Okay, well, we can do something different than that. Then this is my kid's 529 and 7. Or here's my retirement. Okay, well, part of your retirement, if you live in retirement for 20, 30 years, part of that money isn't even going to be yours or shouldn't be needed for 20 or 30 years. So you shouldn't be conservative with that piece. You have to figure out how much that piece is, and that's your 15-year bucket. And you can be more aggressive with that because you have 15 years before you need it. So we'll walk you through that. One of the questions, so the first one there, private preferred stock. I would get this wrong. So the fact that you don't know, haven't been exposed to this, don't feel bad. This was in my world and I got the answer wrong. If I was on Jeopardy and the question was, can a public company like Apple or IBM sell private securities? I would have said no. M&M, Mars, and Wawa, they're private. They're going to sell private securities if they sell any securities. IBM and Tesla, they're public. They're going to have to sell public. Well, I'm wrong. Companies that are public, if they choose to, they can create a asset class of preferred stock. So it's higher than common stock. It's not on the debt side. It's on the equity side. But it's out of the market. So you're buying it from them, and after 5 years, they're giving you back your money. No growth. They're just giving you back your principal. But they're paying you, this one that we have is paying almost 8%. That's out of the market for 5 years, and you have no stock market risk. You have that company risk. Did you have a question? What's your
No, I'm
hand?
just thinking, I was thinking
Yeah.
as an example, like, aren't those, I can't remember which company, like, is it Facebook or Google, like investing in that OpenAI, which I think is a private company?
Yeah, same idea.
All right.
So what happens is the company themselves has to elect to, and why would they do it? So I always follow the money. I grew up with the X-Files, I trust no one. I grew up with Ronald Reagan, trust but verify. I am the most, I don't trust any. If everyone's walking in a direction, I'm looking at the other direction, probably just out of defense mode. Like I am not the guy that follows the herd. Little fun story. Remember when HD first came out, and I had my first deal. I'm like, all right, I'm gonna go to Best Buy or Circuit City, whatever around. I want the biggest TV I can get for this check. So I just it was a DLP, so it was I wish it was this thing. This thing was like 5 million pounds of the principal, and there wasn't much to see in HD when HD first came out. So I'm watching literally like the HGTV channel where they were interviewing a farmer who was a cattle farmer. I'm not into cattle farming, but I had to watch something in HD. And the cow looked real, and the beautiful brown eyes of the cow were right there. I could see the soul of the cow. It was such a crisp picture. And then the interview was like, to the farmer, how do you get these cows to go to slaughter? And the farmer's like, I just have to put one or two in the direction they all follow. And I realized that that's the way I want to explain to everyone. If you know some of the things out there, if you could be the cow that is walking in the opposite direction with a little smirk, that's how you make money. Not just personally, but that's how everyone makes money, is they're going away from where everyone else is going. And it's a great, and it's interesting because that explains the market better than my MBA, 2.5 years of an MBA. What was the question that came up on that? I want to make sure I capture it.
What's the 1, 3, and 5-year return percentage on 10K invested in accredited private and private real estate?
Yes.
What's the expense ratio for each?
Love it. Depends on the investment. We don't really deploy any money unless the total return is double digits and the income's high single digits. So we have investments that have Bernie Madoff numbers, and the fact that they're crazy numbers because we have to be in oil before Ukraine, and that so they're not typical returns. Typically returns, we are a risk off. All the investments, although they're new to you and they sound, and the ones we use are not complicated by default. If I can't explain in a white cocktail napkin that you get at a bar or at a wedding, that white cocktail, like that small white cocktail, if you can't explain an investment on that, don't get into it. It's when they're complicated and there's derivatives and there's all these complications, there are the times where when things hit the fan and everything hits the fan eventually, it's not going to work as advertised. So the short answer is that there's not one answer because there's thousands of it, but nobody with money would do it if they weren't better numbers than what they can get somewhere else. So that was the perfect answer. So private preferred company, that's a company that's selling preferred stock. It's not in the market, so it still counts as a stock. You don't have to be accredited. This is not $1 million. This is you got to have $70,000 net worth to put 10 grand in. Like it's not a big piece of the pie. It's just, can you have a piece of the ingredient? It depends on your personal net worth, and that's the government program. So we're going to walk a little bit deeper through that, but I'm just going to quickly go over. So I promised you a little bit of trivia. Downtown Phoenixville, Riverworks is a 2 years ago, $100 million apartment complex. It's now an $80 million apartment complex. Nothing wrong with it. Interest rates have gone up, so the price of anything based on interest rates goes down. One of our companies, and it's a company you've heard of, Cantor Fitzgerald, bought that, and that's in what's called a DST, Delaware Statutory Trust. When an investor either sells an investment property and does a 1031, you can exchange. Let's say you make $100,000 on what you sold, and it's property. You have to sell property. Instead of paying taxes on it, if you exchange it into another property, you don't have to pay the taxes. But it has to match evenly. What we do, and what has happened, and what we have now in Phoenixville, is Toll Brothers sold it to Cantor Fitzgerald. Cantor Fitzgerald put it in a wrapper of a DST, and that stands for Delaware Statutory Trust. I promised I wouldn't talk like an MBA, but that's what this is called, so I'm not going to make up the word. And basically what it says is whatever's in the trust, the properties of it get transferred to the people that are in it proportionally. So if you have a piece of real estate in it, when you put money into that same piece of real estate, it's not a REIT, it's not an LLC, it's not a partnership. You have settlement and you own 0.00025 of an $80 million building. Now that building, ironically, it's about 50% leveraged, which means there's only $40 million of equity. We were joking today earlier, Mark and I, Vanguard just made that when I told you that story. Like it's not the same scale. We're not talking trillions of dollars. All of the really good investments would not work if everyone had access to it. We couldn't do it for everybody if everyone did it. We couldn't do it for anybody if everyone did it. And so one of the common themes that we look for when I'm looking, because we're now at the point where people are calling me saying, hey, I have this investment, can I put it in front of your clients? And the answer is no. We drive what we want to put clients into. But one of the themes that I look for, and I recommend you look for it too, is does this investment have a legal, ethical, and moral unfair advantage? If there's not an unfair advantage, then you are just holding and hoping someone pays more for it. The stock market thesis that no one talks about is the bigger idiot. I bought Tesla today hoping there's a bigger idiot a year from now to sell it to because it's worth more. No, I'm not saying Tesla's in it, but I'm saying, the only way you can make money in the market is there's someone willing to pay more than what you just paid for it. And the only thing you can do is buy, hold, and hope. There's nothing you can do personally. Just because I bought Tesla or you bought IBM or you bought Microsoft, we're not moving the stock. None of us have enough money to even make a blip into it. So if that's the case, you know, you want to have some sort of, so cash, that's a good question. We're going to get into that. So preferred stock is a safe, depending on the balance sheet of the company, it's one of the safest allocations that you can have to the company because it's flexible for the company. So why would the company do a preferred stock? If they have a preferred stock and for whatever reason, and we work with companies that have never not paid, but if they don't pay a preferred stock, you still accumulate it, they just don't pay it. It's cumulative, but they don't pay it out. But their world doesn't shut down. If you have a bond with a company, that same company, and they can't pay the interest on the bond, well, now you're going into, now someone's going to court because you had it. And so you can be way more flexible with private equity than you can with bonds. So companies get out of it the flexibility of it. It looks like a bond to them because they owe the 7.5 or whatever, but it's flexible for them. So I'm going to go over some returns, but basically if you want to see, when I say DST and I say institutional properties, what I mean is properties you walk by every day and don't even wonder who owns it. Eventually, if it's in a DST, regular people are owning that. Cantor Fitzgerald owns it just to put in a DST, and then your equity, investors' equity, is going to replace the $40 million that they have equity in the property. And the reason it's only $40 million is it's appraised for 80, it's 50% leverage, it's not going, we're not raising a penny more than 50%.
That was just sold about a month ago. Is that still,
There's,
that was just resold again?
yeah.
We live there, actually.
Yeah. So the Cantor's the last buyer. It's now in the DST. I'll see you there tomorrow because I'm having an event there. It is oversubscribed. More people in the country want to go into it than there's equity left. So, but I'm going to walk you through other DSTs or Amazon distribution centers. Like, I'll walk you through what we mean by that. But the neat thing is, for people that are working professionals and they qualify, you can put cash into a DST, and instead of you trying, let's say you have $50,000, you're not going to get the nicest property in Pottstown with a $50,000 deposit. You're just not. Sorry. But you can put the same $50,000 in an $80 million building that's already leased up. So that's the scale of it. And we're going to walk through. Now, it's not liquid for 5 to 8 years. Even if you die, your family isn't coming out of that because they have to run that apartment building in this case, or that Amazon distribution center, whatever the DST is. They have to run that long enough to get appreciation so when they sell it, everyone get their money back and return, and they get income along the way. But what a DST is not, it's not a build it and hope they show up. A DST is always an individual building already built, tenanted, cash flowing, and your equity is just replacing the sponsor who's like the managing partner equity. So this is something that's 18 years old and no one's heard about it. And a DST is an updated version of a tenant in common. So if anyone has real estate exposure, tenant in common, if the three of us own a building together, we just agree, we'd have to agree to do it. But when you have 300 investors, you always have that one guy or girl saying, I'm not selling for 500% return. And so a tenant in common isn't good for institutional properties with investors that are strangers, because you always have that one, you know, I'll keep my language clean. You always have that one, you know what, messes up the whole apple cart. So we're going to go a little bit into that, and I'll walk you through what that is. Oil and gas tax credit. So really, there's 3 ways to pay less in income taxes. 1, make less income. No one ever wants to do that, but that's an option. 2, give away your money. You don't need me for that. You know what that's out there. You can open up a foundation, give it to the church, give it to the library. Mark would be more than happy to take you. Now, it reduces your income, but also reduces the money you have. It reduces your income taxes, but by reducing your income. The third option is if you put your money into something that the IRS sanctions as allowable to reduce your taxable income. And so oil and gas is out there. This thing has been out there since 1942. Those of us who are history buffs, World War II. That tax code's still on there. And what it is, it basically, if I bought a pitchfork to go look for oil in my land, I could write off that pitchfork. It's called an intangible drilling cost. Well, instead of a pitchfork, what if I buy all the equipment I need to develop and take out, we're talking millions of dollars, I can write all that off. So what it means to an investor is about 70 to 80% of what you put into the investment, 70 to 80% of the number, I'll use 100,000 because it's easy math, about 70 to 80%, depending on the program. So it's not going to be an unknown, it's just they range between 70 and 80. Let's say it's 80, let's say it's 75, I'll split it in the middle. it means you get $75,000 off your taxable income if you put $100,000 into the tax credit investment. And you still have the asset, and now you're getting investment like it's oil and gas. Now here's the cool thing. You get the same write-off if you're the first person on the plateau, and we don't know if it's there. We only work with deals that are like the 17th and 18th project, at like the Marcellus Shale, where we know it's a big, big, big development. So you get the same write-off whether you're the first one or you're in the 15th developed program. Don't ever be the first, but as long as there's stuff in the ground, you're going to get the tax credit for all of them. So we're going to go a little bit in there. There's some really good numbers there, and there's two types. One, you never get your money back. You're only going to get distributions for like 20 or 30 years, and one that you get made full in 5 years. So the client gets to pick which one they get. But both give you the write-off of income, and I'll go through it. Outside of the tax credit, you're going to see, and private equity does it, there's real estate plays that do it. That napkin theory is not, you know, I don't say because to be cute. There is a MBA 101, you can ask ChatGPT about it. There's, in most industries, there is what's called an aggregation play. And that is if you have a business that creates something attractive to a large company that has the money but doesn't have the time to do the work to build the thing bigger. So for this oil and gas, for number 4, it's a North Dakota company for the last 25 years does one thing. They buy instances of ownership of already producing gas wells, oil wells. So you don't get the write-off because whoever started it gets the write-off, and they did it 15 years ago. So there's oil left in the ground, but you're buying it from the developer who really just wanted the write-off, now doesn't want to run it anymore. But there's CapEx, meaning there's capital expenditures to add extra derricks on these grounds. If you're a partial owner, you're partially obligated for that CapEx. So let's say you donated your land and it has oil on it, and so you got $1 million of the project, but now the project's saying, hey, we're going to do $5 million of new equipment. You're going to now be, your family's now on the hook for $500,000, $600,000, $700,000 to be part of that new buy-in. And a lot of places don't, you know, I just give me my money back. So what this company does is they take these, you know, from Fred, from Mark, they take all the little pieces and they make it a bigger piece. And once they own enough where it's generating about 5,000 barrels a day of all these $500,000, $1 million, like they sell it to a bigger, you know, an ExxonMobil, a Chesapeake Energy, you know, any of the big guys that play in that world. So that aggregation, and you'll see it a lot, there's a lot of places that do this with convenience stores. And so you make a portfolio, you make them run better, and then you sell it to someone who just wants to own them, but they don't want to buy them, and they don't want to negotiate, you know, for each of them. Regulation D. So Reg Ds are in the business. These are flash in the pan investments, meaning they're not a fund that is the same fund for 15 years in a row. I'll walk through what they are, but they're always a short-lived, limited opportunity from an environment standpoint, meaning, hey, because of interest rates caps, there's a disconnect in the market, and we're gonna just do that disconnect. I'll walk you through what that is, but these are always something different every time we see them, and we don't make anything. So everything we're talking about are always third party. My firm's a hybrid. We're fiduciary, we're registered fiduciary, and we also have a side that has a boutique broker-dealer. And so we're regulated by everybody and their brother, you know, 2 different entities, which is fine. If you keep your house clean, you don't care how many people come and visit. Reg Ds are everything we have to show clients, and everything I'm talking about today are all FINRA and SEC regulated, and they're not anything I make. So this isn't a Fred show. These are Cantor Fitzgerald owns that, you know, what used to be Toll Brothers River Works in Phoenixville, right near the, it's not Iron Hill, down by the foundry. It'll be across from the foundry. So if you want to know who owns that, a bunch of regular people now, you know, regular people that have $1 million net worth. And then syndications, we'll walk through what that is, but that's private preferred stock. The one that we've been using now is 5 years. It has a 6. It's currently paying that 7.8, but really it's 2.5% plus the federal funds rate. So if the federal fund rates go up, there's an up. If it goes down, it'll go down, but that 6% is the minimum. So that's really, you know, that's how that works. And for 5 years, your statement is so bored because all it is what your money's worth, because they're paying you the interest, and at the end of 5 years, you just get your money back. So as of now, if there were seared CDs paying that, I'd rather you do a CD. But the highest CD we can get, that's a 5-year CD, is still, low single digits, 3, 4, maybe 5, nowhere near almost 8. So again, not for all pieces of money, but that's a big piece of it. We talked about this before, so I'm just going to, land the plane, as my wife would say, just kind of go full circle. No common. It's usually backed by a public, the ones we like are backed by a public REIT. Because a public REIT is traded like a stock, it has a ticker like a stock, but it actually owns real estate, and real estate can't go to zero. Companies can go bankrupt. There's a lot of good companies that go bankrupt. Fisker going bankrupt, I think, 3 times. Like, there's companies that just go bankrupt. We like things like farmland, things that are going to be needed no matter what happens. We're very defensive. We think that the next 3 to 6 months, maybe next 18 months, will be very choppy in the market. We think there's a lot of embedded risk that no one's really recognizing. And the people that shouldn't lose are going to lose the most. The people that have no protection, have none of these alternative investments, which is really sad. And all I really think in my head, I'm trying to lift the velvet rope to let people, get over here. Just before anyone sees you, let's get into first class for at least some of the money. And again, some of this doesn't have to be for accredited people. So it does matter what the preferred stock company is, because if it's an AI company or a tech company, just because it's a safe asset class at capital, the capital structure, if it's a bad company, you're still going to lose money. And if it's a company that goes bankrupt, you're going to lose your money just as if it was public common shares. So you do want to know that. I always believe that you need to know how people get paid. For most of the alternative investments we do, including the preferred stock, we're paid by the sponsor, so it doesn't show up on the client statement. So if they do $50,000 into a preferred stock, their first statement shows 50 grand. Our firm's paid to be the fiduciary. Our firm's paid to take the bullet if it's not the right investment. We get sued, not the company, because the company isn't in the selling private preferred stock business. They're in the whatever business the company's in. So for the farmland REIT, their business is buying and managing farmland. And the neat thing with farmland, and I didn't know this, if it's a recurring crop, so think pistachios or almonds or anything that you don't have to blow up and then replant. It's not corn. Corn, you got to knock it all down and put it all back up. Almonds and pistachios and a bunch of other, a lot of them are nuts. You pick it up, but the plant itself doesn't go away, so then you can depreciate it. You actually can depreciate, like these firms can depreciate crops that are recurring crops, because it's an asset, which is really cool. So costs are paid by the investor. This isn't a commission that you pay someone. So we talked about institutional DSTs. The best example is downtown Phoenixville. Riverworks is now owned by Cantor Fitzgerald. It is a DST. Investors around the country, including my clients, are getting into it, and it's already pre-sold. It's already sold out. So I'm not. But when I say institutional real estate, nobody knows what I'm talking about. What I'm talking about, the Amazon warehouses, the Amazons that they're building themselves. So interesting thing about Amazon, when you think Amazon and Apple, everyone says, oh, they're the same. They're about the same size. They're both really big companies, a lot of people, a lot of profit, blah, 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 blah. 1 month of Apple, 1 quarter of Apple revenue last quarter was more profit than every quarter of Amazon combined, going all the way back to when Jeff Bezos had a cardboard box for a desk. Amazon is very large. They deal with very big numbers, but look at the underlying profit. You order dental floss on Friday, it shows up on Sunday, and it's free shipping, and it's the same price you paid you would have paid at Rite Aid. There's not a lot of margin in that. And if you remember the very first Superman, I'm dating myself because I never saw the movie. The very first Superman with Christopher Reeve, Lex Luthor made all of his money by rounding out the zeros at the 4th decimal point, because no one ever sees the money. So he had trillions of dollars, because it was, well, that's kind of like how Amazon's making their money. They're making it fractional pennies on everything. So the reason I'm telling you that is most Amazon warehouses, even the ones that they own and they bought, they don't own because they need to get the money to go do it again. So they buy the land, they put the super Amazon in, or they go in with FedEx, and they make it a sortation system. And you know these places, you're driving on the turnpike for 7 minutes and you still are by the building. Like, these things are huge, 300 million square, like gigantic. Well, they make their money having it, so it's closer to you to give you your CV, they give you your dental floss in a day. They don't make any money owning it. That's the difference. They make money having it, so close to you, but they're not making money owning it. So what they do is they build it, and then they sell it to a company that puts it in one of these DSTs, and then leases it back for 30 years. And you as an investor, you're in a DST for 5 to 8 years. Because you want to get out, you want to be able to sell it with juice lift and the squeeze. So if it's a 20-year lease, and you're out in 5 years, someone's buying that building, not only because the building's worth more in 5 years just from inflation, but they have 15 years left of the Amazon lease. Now, in 25 years, we might all have replicators and we won't need distribution centers. That's not going to be my problem because I'm out in 5 years. So the next 5 to 8 years, Amazon's going to be safe. 50 years from now, I don't know if we're going to need to ship things because we all can, have a 3D printer. Second place. So that's obviously, and these are, if you look at these, none of these are sexy. None of these are like, oh my God, I read about these. These are just normal, these are cocktail napkin things. These are, they're not, they're alternative and they're accredited, but they're not weird. Like you can understand this. Recession-resistant retail. The only asset class in history, and going back to the 30s, let's go, the Great Depression was 14 years before things got back to normal. None of us are around that remember that, but if it happened once, it can happen again. And 14 years is someone's whole investment life where you've lost money and never got back what you had. There's a type of real estate that did well, and we, in COVID, not one company, not one of the tenants in one of the investments never paid one of the months. Like it is, and so what it is, recession-resistant retail. Think blood dialysis centers. I don't care if you have to be in a hamster ball. You're going if you have to go. If COVID comes back, you still got to go and get your diet. So grocery stores. You may not go into the store, but you got to go to the store, or someone's going to the store to get the food to bring it to you. Auto repair places. So what ends up being the answer is, if you can have a triple net lease of a recession-resistant retail, and the lease is backed by the mothership or the head company, you're going to be fine. So triple net lease basically says you're renting, let's say it's a Kroger grocery store, which is one of the ones in there. They rent the space from us, but every other expense is up to the tenant. So if you own real estate, you're like, whoa, what about taxes? Triple net lease, not your problem. Well, what about lawn care? Triple net lease, not your problem as a landlord. It's only the tenant's problem. Triple net lease means all the expenses besides the rent, besides having access to the building, all the other expenses are on the tenant. Electricity, HVAC, if the roof needs to be replaced, all that stuff isn't on the landlord anymore. So that's a great kind of real estate when you have investments and expenses in insurance. Insurance are changing people's lives. I have a client moved to Florida and is paying more in insurance than the mortgage. He's like, this is what we mapped out. I'm like, well, I didn't map out your insurance doubling 3 years in a row. Like we didn't, it's not in the Monte Carlo I ever read or ran. No, luckily, we just made money over here to pay more over there. But recession-resistant retail is a safe retail. Here's the downside of it. You as an investor are never making more income than the already agreed to lease with the lease bumps. So it's not like at the multifamily and at Cantor Fitzgerald in Phoenixville, it's a regular apartment building. If apartment rents go up, we're going to make more money. If we have to cut the rents because of whatever, we're going to make less money. Like, it's just that simple. But we still own a piece of an $80 million building that isn't going anywhere. I don't think Phoenixville's going anywhere. We've been an anomaly in a bubble in our area for 20 years, so I'm pretty sure whatever's happening is still going to keep happening. Yes, it's getting expensive, but that's why multifamily is, you can't buy a house in Phoenixville, and most people, there's a waiting list to even get into Rivercrest. And it's interesting because what you're paying for that type of high-end apartment is what we would be paying for a house 5 years ago, but there's no houses for sale. So recession-resistant retail is a big one. Storage. Maybe not this room and maybe not the TV and those guys on Zoom, but other people like their stuff. And so if you go into an apartment, you got to put your stuff somewhere. You're seeing storage everywhere because that's where money is. And with storage, if you own storage, either as a DST or as a standalone, the rent changes daily. So you rent a storage unit today, and because of the demand in storage units, you go in a week from now, your storage unit rent will be different than his. And they have now software that can say, okay, this new apartment building's going up, these new people moving in, we're jacking up the prices. And so storage is a good one. Grocery stores we talked about. Multifamily. Multifamily now is better than it was 3 years ago, and 3 years ago everyone was talking about how good it was. The reason it's better now is because the interest rates have gone up so fast that all the multifamilies are down 20-30% at the property level. Now they're not worse companies, they're not worse properties, it's just you can't, there's no comp, there's no Zillow for an apartment building. So to decide what that value of the apartment building is, an investor has to say, well, what's the cost of buying it? Because no one has $80 million to buy a Toll Brothers building. And if they did, they probably wouldn't put it all in. You're not making any money if you put all your money in the property. So you have to have some leverage, you know, to get some return on your equity. So when interest rates went up, it made every multifamily more expensive to own, because now your new loan will be higher. To compensate and to be competitive, the current value of those multifamilies came down. That's automatic. You didn't do anything. Nobody wants it to go down, but I can't get $100 million of date, so now it's only worth 80. So that building could have been bought by Cantor a couple years ago at 100, and they looked at the number like, oh, we'll wait. Year and a half later, it's now worth 80. All right, we'll buy it. And here's the check. Because they already knew that people like me needed the DST, because I have clients selling real estate, and they needed to put it into something and not pay taxes. Mobile homes. I don't know if you know this, but these are cash cows. 2 issues about them. And it's interesting. There's probably not going to be many more mobile home parks in our careers, because nobody wants one in their backyard. And with the new laws, when you build a new mobile home park, you have to put in all this very expensive infrastructure for, you know, you got to have no lead piping, it has to be the right, like, you have to do it right. It's so expensive for the infrastructure, you're never going to rent a pad. Because most mobile home parks, you're just renting the land and the services. The person owns the house. And so, you know, multifamily for what's already, you know, mobile home parks that are already built, they could be good investments. Unless the guy selling it knows that the laws have changed, and now in the next 2 or 3 years, all of the infrastructure and all the pipes and all the lead pipes have to be replaced. In some cases, that's going to be more expensive than the cost of the mobile home park. So we know who the players are that are getting out. We know why, and we're not touching it. But mobile home in general, again, there's things to look out for. And my favorite, because I have to take an exam, anyone in my office, whenever we do an investment, we have to take an exam to say that we understand this alternative investment. And ironically, they don't last very long. They maybe last 1 or 2 months, so I am constantly taking exams. To the point now that I don't even look at the documents, I just take the exams because I know what they're trying to say. I got the question wrong here. It was for a government building, how long is the lease? And I just clicked 25 years. That sounded like it was one of them. No, it is the lease was backed by the last remaining ancestor of the current president when the lease was written. You ever wonder who owns government property? That's how the leases are, because you can't have the government own anything because they're not not a person. And you obviously can't have a president own anything because it's not theirs and they're not president forever anyway. So it's the last remaining descendant of the president that was president when that building was sold at a lease. So mine was George H.W. Bush. Now they can renew the lease and then just be whoever the new president is. But government buildings, Social Security offices, those things are in DSTs because the government wants to buy it and build it and lease it back and get money somewhere else. So it's a strategy that goes out. There's always going to be Social Security offices. Like at the end of the day, there's going to be Social Security offices. There's going to be a ton of common sense real estate that isn't going to go away, and we just have to be smart. So I'm going to quickly go through this. We talked about it, but anything that's in oil and gas, you get anywhere between, I'll say 70 and 80. This is 75 to 80, but I want to under-promise and over-deliver. 70 to 80%, and then the return's about 15 to 20% a year. So that answered one of the return questions, Mark, to our listener out there. And that's not counting the fact that when you do an 80% deal, you get to take 80% off your income. Whatever your tax bracket is, you just made, because you didn't have to pay it. And that's in your pocket. That's not even in here. We tell everybody 5 to 7 years to get your money back, and then it keeps paying for 20 to 30, sometimes 50 years. I have family members who are 3rd generation receiving a check that 3 generations ago someone did one of these. Because these are projects that are creating oil and gas. A lot of times, Western Pennsylvania, Marcellus Shale, we do a lot of natural gas there. As long as there's something in the ground and we get it out, the client gets money. And you always have the engineer who's like, well, what's the IRR? Like, I don't know. It's like, what do you mean you don't know? I don't know how much is in the ground. I don't know the price of oil for the next 30 years. But if you figure that out, there's your answer. And it's impossible to know. But it's never for us and we look and we do the due diligence. It's never taken longer than 5 years for someone to be made whole. And I tell all my clients, you don't make any money until you've gotten your money back. Because then you can count the money as being made. Because if you're getting paid your own money, you don't really make anything. I mean, that's not, you haven't made anything. So that's one way to pay less in taxes. And we like to work with firms that have more money at stake than I do or my clients. So there's a billionaire family outside of Pittsburgh. They are doing projects at $60 to $80 million increments, and they're doing 30. If it's 60, they're going to do half, and then the other half is what is offered to other people. So no one's going to have more money than the people who own it at the family level. But they're not in the oil and gas business of selling oil and gas. They're in the raising money to develop the oil and gas and sell the oil and gas to make money, which is a completely different thing. Eventually, once they have about 140 acres outside of Pittsburgh, all on the Marcellus Shale natural gas formation. Once they're done with those projects, might take another 5 years to get all done, they're done. They're not, I mean, we're grandfathered in and grandmothered in, but they're not selling, they're not offering any new projects. Their business isn't selling this stuff. Their business is using the money, and the tax credit comes for a ride. So I hope that makes sense. We talked a little bit about this. So this is basically buying from small families, small instances of ownership, and then putting it together and selling it upstream. So the numbers aren't bad. It's basically you start getting money within 6 to 9 months after, because you have to buy the stuff. And so these aren't instant. Some of these, like the DST, you do get money the very next month because they got rent and you're now an owner. Some of these things, they're building something that wasn't built before. So there's a delay to what you could, when you're going to get money. And then because this isn't the write-off kind of tax credit, they're able to offset the income, and this pays 10% a year. They're able to offset the income 1-to-1 with allowable deductions because it's oil and gas. So you make 10% and you get a K1, which is, that's a lot of these things are K1s now, so you're not getting your taxes done in January anymore. They map out equal to expenses that equal to your income. So it's 10% of income with 10% of expenses, which means the income is tax-free. So if you have a really good tax bracket, 10% tax-free a year, it's not a bad number. These are no market exposure. You are exposed to the oil market. Again, as oil changes, what they can sell it for will change, but they're not going to sell it for a loss. A lot of these companies have a track record of what we call going full cycle. So they raise the money, they do the business, then they sell it. All of that gets recognized, and almost like a baseball card, well, here's our IRR for these investments. It's required to show all the previous investments. So when interest rates did jack up a couple years ago, there were companies that took all the products off the market because they didn't want to have an ugly score, so they didn't have any products on the market. So to us, that's how we know you're dealing with decent people. They're not just putting stuff out there. If you want to sell something and it's not real estate, an opportunity zone fund allows you to defer capital gains. So when you sell something, your cost basis comes back to you, meaning what you paid for it. But the capital gain is what's taxed. You have, if you want to not pay taxes, you just move the gain into an opportunity zone, and then you don't have to pay the taxes for a couple of years. And all opportunity zones are real estate based and ground up development. So unlike a DST, one of the opportunity zones that we're in, I'm personally in, was literally a crack lot outside in South Philadelphia, and they're putting in an $80 million life sciences building. And then I went there to the ribbon cutting, to the shoveling, I guess it was called, because everyone had the gold shovel. The mayor was there, and the company doing it agreed that at least a third, if not half, of all non-skilled services will be sourced from the neighborhood. So security, cleaning people, all that so the neighborhood wanted it. It was a job place, but it was awesome. It was an opportunity zone, which means investors going in can invest and not pay any taxes on their capital gain. Shoot.
I think Coatesville is an opportunity.
Yes,
yeah.
they're all over the place. There's this 4,000 opportunity zone fund, or opportunity zones. This is a fund. So an opportunity zone like Coatesville, you wanted to build something in an opportunity zone fund, you'd have to do it yourself, and there's rules to follow it. Because here's the cool thing: once the thing's developed and sold down the road, in time, the gains are also tax-free. So if you put $100,000 in, and in 10 years later it's sold for $1 million, you don't pay any taxes, and you get the $1 million. I'm making the money now. It won't be $1 million. Maybe it will. I don't know. So if someone has tax issues, they're going to have a few tax issues. Tax issues from income, well, that's oil and gas. Tax issues from potentially selling a property, you can 1031 in a DST, or you can do an opportunity zone for property, but opportunity zone is the only thing you can use for everything else. So you want to sell a collector's car, and it has no cost basis, it's worth $1 million, and you don't pay the taxes. That can go to the gains can go in an opportunity zone, because you can't 1031 a car. You only can 1031 real estate. And then at the end, the gains come out like a Roth. They just get a check at the end. So that's opportunity zones, and these are meant to give you things to Google after this call. So I'm not there's tons. We could do an hour just on opportunity zones, and I know I'm talking fast because a lot I have 22 years of stuff I need to tell you about. That was the income side. That is, when we talk about the boiling water, we want it to be ice or steam, whichever one you want to be income. This is the opposite. So these aren't meant for income. They might give income. They're not meant for income. They're meant to be worth more than they are now in the future. That's really what growth is. And again, a lot of times, private equity, there's two types. First type is, and what we would recommend to be the first type is you can go into a fund of funds that already have all different private equity turnaround projects already going. And that's the safer version of it. It's perpetual. A client never has to get out of it. They can get out of it after a year, but they don't have to get out of it. It's not like it goes full cycle. This one's neat because this is a different one. This is a firm that you put, let's say, $100,000 in, and they will take a piece of your money, and depending on the company may, let's say the company has a B round where they're raising $1 million to $10 million, and you have $100,000 in the fund. They may carve out $5,000 of your money to go into each of these rounds. So you're not exposed. You get to have way more. For that same 100,000, might have 10 or 12 different seed capital. So this is where 80% are going to lose money, maybe all of it. But the 1 or 2 of the 10 are going to knock it out of the park. So this is not for everybody. This is not for the big piece. We tend to say, okay, let's do the fund of funds, because that's way more robust and way more, safe, because it's thousands of companies, and even if someone, you won't even know it. And then as a sweetener to that, I want to buy the next Facebook. Well, no one knows what the next Facebook is, but at least here you'd be able to buy into, and the company automatically sources. So you get to micro invest in private equity, which typically, outside of these kind of strategies, most private equities are 7 million blind pools. So most people who are buying into private equity are not people. They're institutions, they're sovereign wealth funds. Like, who's going to write a $7 million check to go into a blind pool, which means you don't even know what you're getting into? And for 3 years, that type of private equity, which is not this and not what we recommend, that type of private equity also has capital calls. So you wrote a $7 million check, you're in a blind pool, you don't even know what the heck you're in, and for the next 3 years they can ask you for $700,000, 10% of whatever you put into it, a year for 3 years. No one signs up for that unless you're an insurance company, unless you're a gigantic company. So what we do is we don't do that kind. We do all the kind that are not that. Does that make sense? So private equity is like the color blue. There's 7 billion shades of it, and you don't know which one I'm talking about because you don't know what's in my head. You really need to be careful. We make sure private equity is standardized and on the safer side. And there's a new private equity just brought on. It does not require anyone to be an accredited investor. So most private equity is like Richard Gere and Pretty Woman, like we talked about. The other private equity, there are family-run companies where the founders are getting up in age and they would like to get some of their money out of the table and retire. But they're private, they're family-owned. So they don't want to go public. They don't want private equity coming in and messing things up. So we found a private equity firm where their niche is to support the retiring founders. They'll buy 10 or 20% of that private company, But 10 or 20% means the family's still in charge. 10 or 20% means they don't really have a lot of say. So you as an investor get to have a piece of all these little private companies that are never for sale, that are never in the market, and are highly, like they're sorted and basically critiqued to make sure they're right to be in the portfolio. But now you get a tiny piece in this one fund. If you put 25 grand in it, 50 grand, that will be diversified just like a mutual fund into a bunch of different private companies that are not for sale. Private equity, to answer the, I'm sure he's thinking, whoever asks about if you're not getting double-digit returns most years, you're probably not doing it right. And so private equity is 10 to 12, but we have private equity that is never, and there's private, it's out there, never had a negative year. Now, some years it's 3%, even if the market's up 30, but having money that isn't in the market where there's an intrinsic value add component, meaning they don't buy a company unless they know what they're going to do to turn it around, that's really where private equity comes in. Private equity is the largest and oldest asset allocation piece of the pie for Harvard and Yale. So if you look at Harvard, Yale, the foundation annual reports that are available on the internet, you'll see private equity there. It is the largest holding, has been, and is the oldest holding. They're in and out of different real estate all the time. They've never got, now they might change who their manager, they might go from Carlyle to Bain or Bain to KKR, like there's some big players out there. We have access to all of them. The neat thing, when you use all of them, you don't have to worry about who's right, because they're all going to have different days where they're righter than the other. This is fun. So being where I'm at, 22 years doing, figuring out, knowing my parents were not rich, I wasn't rich, and I knew the rich got richer because they knew things the rest of us didn't. I've researched how wealthy people run and built this building, built my office around it. One of our clients, I helped him buy a jet, and so he's like, well, I want to fly down and meet my dad. I'm like, all right. So he owns 18, we'll call them fast food, but they don't like 18 franchises, all the same kind. And his name's Mike. I'm like, hey, on the way back, like if I would open up my first, let's say Burger King, whatever it was, and you want to open up your 19th, you already have 18, do I have a chance? He's like, no way. So that got me, remember earlier I said we look for legal, ethical, and moral unfair advantages? I never realized how much control the franchise company has to make the kings. If you have 15 stores, and I have none, and you want to open up number 16, I don't have a chance. And if you own the franchise company, you don't want to take a chance on me because you know he's going to do it. If he has 15 well-run stores, 16 is probably going to be well-run. If you have no evidence that I can run a store, even one, I'm not going to get a chance. Now, is it fair to me? Life's not fair. So I didn't land the plane. The plane landed the right side up. I go to my car, Mike went into his car, and I went to the office and I looked for, and we found a private equity firm that only goes after retiring baby boomers who own, at the time, and this is Dunkin' Donuts, KFC, and Taco Bell. Now, it might sound like they're completely different companies. They used to all be under the Yum brands, and so the back end is all the same operating system. It's the same stuff. So I'm not concerned about fast food being bad if the market goes slow or if the economy goes slow. I'm concerned with Chris's and all the nice places because that's the place we're not going to go all the time, but we'll probably still go to KFC or Dunkin' Donuts. So the franchise companies are the kingmaker. Anytime you're doing fast food, you're really doing it where a bulk of America either goes every day or can go, and probably isn't as recession sensitive because it's a place we're going to go and we can't afford going to other places. And it's a huge business. It's $301 billion and it's up to almost $332 billion just 2 years later. And that's during at $301 billion in a COVID year. People still went out to eat those places. So this is an LP, so it's a limited partnership, and you get to have access to the portfolio. You own the real estate and the investment, and you also own the franchise. But here's the thing: if you buy a older Taco Bell and you fix it up, which is all they do, they look for the retiring baby boomers who just want to get out. They barely survived COVID, and they just want to be done with it, and they probably didn't add a lot of money to the store. We've all seen the really nice new, you name it, whatever the fast food is. On average, 25 to 32% a year of additional sales when you have an updated store. It's the same hamburger, it's the same taco, whatever the food is, it's the same. But when you make it cleaner and nicer and newer, new people show up, old people come back. 15 to 20% is the average. This firm is able to get 25, on average, 25% return when they CapEx. But here's the other unfair advantage. This company now has the right of refusal of any of those franchises in the areas in which they go. So the last thing about this is if you think about, and we're like, all right, what's the downside of owning a fast food joint? It is the people that you're trying to get to work there. And we all know all these places are, please give us patience or use the kiosk because we don't have anyone working there. So what this company does is nobody, and no offense, but no one's going to be, I work for Dunkin' Donuts or Taco Bell, whatever it is. You're not necessarily like, it's not like I work for Vanguard. Oh, that's great. Work for Taco Bell. Like, oh, okay. Here, you don't work, you work for the company. It's called Tasty. I work for Tasty Brands. And I'm going to be a district manager of 15 Taco Bells. Right now, there's 180 stores in this, and so these aren't small. And they want to get up to 300 and probably sell to a firm that rhymes with BlackRock. Like once it's all built and running and integrated, I'm not saying BlackRock's buying it, but that's the firm. Like once you build this vertically integrated cash cow from these retiring baby boomers, and you need to find someone to sell it so that investors can get their money back. So every investment you need to think of, what is their exit plan, who is their buyer, and have they done it before? And what we do is we are never first. So if you say, hey, this is the first time we're ever doing this, great, go have fun. Let me see how that does before, because all of our clients are rich before they come to us, and they don't want to fly or they don't want a chance. They just want to make sure that they got everything going. How am I doing on time?
A few more minutes.
All right. So the last thing, I want to make sure I hit your question. So I'm going to stop the portfolio. Does that what it look like on TV? Look, hello. I saw that in Star Wars. Sorry. So smart decisions. Take a look at, and there's a bunch of websites out there. My website, ccwmg.com, go to that, there's articles there. I would recommend you go to Forbes.com, put my last name. I don't write about the products, I write about the strategies. So if you read, and there's no real products in the Taylor Swift article I just wrote, so not everything is backed by a product. But if you read, I did an article about that quick service restaurant, but I never mentioned the company. So alternative investments, we scratch the surface. I think you have the idea that there's ways to make wealth, and some people already know about it, and some people know about it and can't get into it, but there's a lot of what we talked about that is available for people that don't have millions of dollars but have 70,000 of net worth that can put 10 or 20,000 in some of these things. So there are other options. I would say that software is your friend. There is a lot of disconnect out there, and I would question whatever the answer is, and really ask, is the answer better for you or for the person giving you the answer? And the good people in my field will say, listen, the best I can do is X, Y, Z, but you might want to look at this Vanguard fund over there. Like that's how you know you're working with someone if they're not trying to take every penny. There's no easy answer for retirement. I would say for most people, bulk up your cash. If you're able to get over 4 or 4.5%, bulk up your cash because there might be some buying opportunities. And there are a lot of really good managers out there. Investing in an index is passive and low cost, but the S&P 500 doesn't have 500 winners. It really has 5 or 6 winners, and they're so large of the allocation that it just makes the whole index go up. So just understand what you're in. If you can have the opportunity to invest in something that grows outside of the stock market, whether it's in something that I talked about today, or you can buy a duplex with your neighbor in Phoenix, like whatever it is, don't just because it's not a ticker, don't be scared of it. You got to do research, but there's no one I have and know that has a lot of money that didn't either put it in real estate or get it from real estate. And that's a 22-year track record of the larger clients have some exposure to real estate. And I think we know why. God's not making any more. Over time, inflation makes it worth more. And if things do get uglier before they get better, and you built cash, even if your only options are mutual funds in your 401k, you'll be able to get back into them cheaper when things have gone down. And there's always cycles. We're just overdue for a cycle, and I think there's a lot of cracks. And all of the headline job alerts, some of them say they're positive, but 10 out of the last 12 have been rewritten and revised uglier 2 or 3 weeks later, but that never makes the news. So I don't trust anybody if they're on TV. Like, I'm just sorry. Don't trust me. I don't, because they all have an agenda, and you got to understand it. And I have friends and family that only listen to what 3, 6, and 10 say. So there's no inflation because they were told no inflation. Like, have you looked at your bills? Like you can't. Some of this you just can't hide. And inflation's here. It was never going to be transitory. And either the Fed was incompetent or lying to us, because you can't have. I can't give you more money as a raise in my office because of inflation and expect that when inflation's down, I'm gonna pay you less money. Like, once you start paying a salary, that's sticky, and you're and it's ugly. Rent, most rent doesn't go back down. So new stuff. I did a whole bunch of stuff with new stuff. Crypto, I am bullish on crypto, and it would only be Bitcoin or Ethereum. We're not talking any of the crazy ones. And I would say, understand you could lose it all, but you can put $25, $100. You can do very small amounts and just get a piece of it. If it's half of the potential it should be and could be, even if you do a small piece, it's going to be worth something, even if it's just a hedge against stuff. And now with all the new apps, you can get into it, get out of it. I would say if you're going to have decent amount in crypto, you can go on Amazon. It's Trezor, Trezor, but it's called a hardware wallet. It's on Amazon. It's a couple $100. Basically, you buy the crypto on the exchange, you put your thumb drive in, and then you can move it from the exchange onto your thumb drive. Don't forget your password, because you'll never get your money back. But now it's off the exchange. So even if that company goes bankrupt, you have your crypto. And so I would say on the most, 5% of net worth, for most clients, less than 1. So we're not talking big changes. There's been nothing in our history of mankind that could be as potentially beneficial but also disruptive as an asset that is global and not controlled by anybody. And we're seeing right now the entire world has a demand for that. If your debt is in US dollars and you're an enemy of the US, we're going to freeze your assets. Can't do that with Bitcoin. And we've been using that dollar as a defensive, even almost offensive weapon, that now people are like, you know what, I'm just going to buy my petrol from Saudi Arabia with, China money or Russian rubles. That's because 2 things. 1, we're being very mean with the control we have, and 2, we have more debt than at any point of time of any industry, of anything that mankind's ever made. The US government has blown out the debt numbers to the point where there's not enough assets to tax to ever pay back the debt we've already spent. And I don't know how to get out of that. And it's not going to be, not everyone's going to be a winner. So yes to crypto. AI is here whether you like it or not. I don't think it's taken over the world yet. I think you're going to see the biggest impact of AI later this year when Apple, 3 years later, does their Siri AI. It'll just work and it'll just be proactive, but it won't be intrusive. And Apple has always made it so that there's no identifying information going to the cloud. So the Google and that type of stuff, they don't even tell you it's secure because they don't want it to be secure because they want to see it so they can create a model around it and then have advertisers come to you. Apple makes money on the hardware and the software and they don't sell the advertising. Google makes less money on the hardware because they practically give the phones away and they make it, so you have to always find out where they are. But I'm pro AI, but I think you need to let AI happen. And there's going to be, just like there was 7,000 car, down to 3, the big 3 car manufacturers, it's going to be the Wild West, and then eventually there'll be a couple key players. Doesn't scare me yet. It does help a lot of that heavy lifting, and yeah, I think we're just getting started. So there's a lot of AI talk and chatter, and it's the new internet, like it's sexy like the internet. I'm not investing in AI. I'm not saying there's a company for AI. You can get into AI. You probably already have AI because you already own Microsoft. You already have AI because Tesla, they have a lot of AI software, and I think that's the other player. There's Apple coming out later this year, and for most people that have a phone that's 3 years or newer, you're going to get it. You don't have to pay extra for it. And then Siri's going to know where you are. Hey, you're driving by the, it's going to eventually know, hey, you're driving by the dry cleaner, and you have dry cleaner to pick up because I saw your email. and it's gonna alert you as you're driving by, even though if you didn't see that email. So that's where we're getting to. The fun part that will happen probably next 5 to 8 years is uses AI, uses internet, but it's the Internet of Things where your gadgets talk to each other. Oh, you're waking up, and now you have a self-making coffee machine, and it looks at your counter, so you gotta go to work, so you're gonna wake up and you're gonna want your coffee. It'll start to, first it'll ask you, hey, when you're up and you have work, do you want me to make coffee for you? You can say yes or no, you can change your mind. But that kind of proactiveness, that's gonna be the fun part of technology that I don't think anyone understands, because there's 400 million devices that are on the internet. Once they start talking to each other to serve you, that's going to be fun. So I'm going to leave it there, and then I'm going to open it to any other questions. Thank you, everybody. I hope I didn't talk too much. CCWMG is my website, Forbes.com, my last name to see articles. And I hope, if you have any questions, you can email me. You can get me on the website.
Okay, thank you. All right.